So, what if I told you that a simple act of kindness, something as common as adding your child to your credit card, could end up costing your family an absolute fortune in taxes? Yeah, it sounds crazy, right? But it's a very real financial trap that's hiding in plain sight. Let's dig into how this everyday favor can spiral into a shocking bill from the IRS. And look, this isn't some hypothetical what if scenario. This is a real and really costly problem that happens all the time. It all stems from a huge disconnect between how banks look at debt and how the tax code treats it. So let's start peeling back the layers on this financial mystery. All right, so first things first, let's set the scene. We're talking about something millions of people do, usually with the best of intentions, just trying to help out their family. I mean, think about it. Parents add their kids to their credit cards all the time. It's an easy way to give them a financial safety net, maybe help out with some expenses, or even give their credit score a boost. It feels like a totally seamless, natural way to share family resources. And honestly, that's exactly where the problem begins. Okay, and this right here, this is the first really critical piece of the puzzle. The law, and you can bet the credit card agreements are incredibly clear about this. An authorized user can spend away, but they have exactly zero legal obligation to pay the bank back. That responsibility, it lands squarely on the primary cardholder. Now, it is absolutely crucial to understand how different this is from being a joint account holder. And this isn't just a matter of words. This distinction is the entire legal foundation of the trap we're talking about. You can practically see the legal firewall here. A joint holder is a co-borrower. They are 100% on the hook for the debt. But an authorized user, they're basically just a guest with charging privileges. And, since most of the big banks have pretty much phased out joint credit cards, this primary/authorized user model is now the standard, which just makes this tax trap that much more common. So we have this very common setup with a really clear legal distinction. Now let's watch how this seemingly harmless arrangement just explodes into a massive tax headache after the primary cardholder passes away. So picture this. A parent dies, and they leave behind a $200,000 balance that their child, the authorized user, ran up on the card. The bank, of course, comes to the estate for the money, and the executor pays the bill. Then the executor does what seems totally logical. They deduct that 200 grand on the estate tax return. I mean, it was a legitimate debt the estate was legally required to pay, right? And here's the twist that catches everybody completely off guard. The IRS steps in and just says, nope, you can't deduct that payment. The estate was forced to pay the money, but it gets zero tax benefit for doing it. For an estate that's in the top 40% tax bracket, that disallowed deduction means an extra $80,000 in taxes. Just let that sink in for a second. The estate is being taxed on money that is already gone. It's been paid to the bank, and it has vanished from the estate's assets forever. This is the absolute heart of the mystery. It feels completely backwards, doesn't it? How can a legally required payment not be a tax-deductible one? Well, the answer is buried deep inside the tax code. To solve this, we have to go right to the source of the problem, a specific and very strict section of the Internal Revenue Code that acts as a powerful gatekeeper for any and all estate deductions. This is the rulebook right here, Internal Revenue Code Section 2053. Think of it like a bouncer at a very exclusive club for estate tax deductions, and it has a very specific and a very high bar that a debt has to clear to get past the velvet rope. And it all comes down to this one critical phrase: adequate and full consideration. That's it. That's everything. It's not enough that the bank can legally collect the debt. For the IRS, the person who died must have gotten something of equal value in return. So let's break that down into plain English. This rule basically exists to stop people from creating fake debts to their family members just to lower their estate tax bill. The IRS is essentially asking one question. When this debt was created, did it actually add to the deceased person's net worth, or did it just drain value away from it? This slide illustrates the IRS's logic perfectly. Look, if you take out $1 million mortgage to buy $1 million house, your estate stays balanced. You've got a new asset, the house, and a new liability, the loan. It's a wash. But when an authorized user spends 200 grand on vacations, clothes, whatever, the parent's estate gets all of the liability, but the child gets all the benefit. The parent's estate received no consideration, so that debt fails the Section 2053 test. Period. Now, at this point, you might be thinking, okay, there has to be a way around this. Clever lawyers must have some arguments to beat it. Well, the tax code has a few more plot twists that make this trap incredibly hard to escape. This is the ultimate catch-22. An executor might try to argue that every swipe of that credit card was a completed gift from the parent to the child. The problem is, the entire definition of a gift is a transfer without consideration. So by successfully arguing it was a gift for gift tax purposes, you've just proven that it's not a deductible debt for estate tax purposes. You've literally argued yourself right out of the deduction. And the IRS has another powerful argument up its sleeve. They'll say, okay, fine, you paid the child's $200,000 debt. That payment automatically created a brand new asset for the estate, a $200,000 legal claim to get that money back from the child. So on the tax return, you get a $200,000 deduction for the debt, but you also have to add a $200,000 asset. The net effect is zero. It's a complete wash. The estate is left being taxed on this phantom asset that it will probably never ever recover from the child. All right, so now that we've seen just how deep this trap really is, let's get to the most important part, the escape plan. The good news is there are clear, proactive strategies you can use to make sure this doesn't happen to your estate. These are really the three main lines of defense. The absolute best, the gold standard, is the clean break. That means paying off the authorized user's entire balance while the parent is still alive. This completes the gift and it gets the cash out of the taxable estate. Now, if that's not possible, you can formalize the whole thing with a promissory note, which turns the spending into a loan. And if it's already too late, the executor has to do some serious detective work, painstakingly going through every single receipt to find any spending that directly benefited the parent, because only those specific charges are going to be deductible. So the crucial takeaway here is this. Informal, well-meaning generosity can collide with rigid, unforgiving tax law. And when that happens, the tax law wins every single time. The IRS really demands that financial support be deliberate. It needs to be a documented gift or a formal loan, not just a casual, convenient arrangement. And that's really the question this all leaves you with. For anyone who has a potentially taxable estate, it's vital to step back and look at how you're providing financial support. Because an act of kindness should never come with an unintended and very, very expensive tax bill for the people you leave behind.